In 1994, financial planner Bill Bengen promised that withdrawing exactly 4% annually from $1 million portfolio would guarantee wealth for 30 years. Yet today, hidden inflation and structural shifts in bond yields mean that millions of disciplined American savers face premature account depletion within just 2 decades. If the stock market drops 20% during your very first year of retirement, that standard rigid withdrawal formula silently guarantees long-term financial disaster. By the end of this breakdown, you will master the dynamic 3-bucket framework that modern wealth builders use to secure permanent retirement cash flow. If you want the calm mathematical truth about building lasting financial independence without Wall Street hype, hit subscribe right now. Let's get into it. To understand why the old static benchmark collapsed, we must first examine what actually happened to bond yields over the last 40 consecutive years. Back when the 4% benchmark was invented, 10-year Treasury yields hovered near 8%, providing a robust risk-free cushion that completely vanished today. Consider Robert, a retired Ohio engineer who dutifully saved $1 million by 2020, trusting a traditional 60-40 stock and bond portfolio. When Robert automatically withdrew $40,000 during a sharp market downturn, he was forced to liquidate core capital assets at severely depressed prices. Selling undervalued shares simply to buy groceries permanently destroys future compounding leverage, creating a mathematical death spiral from which an investment portfolio cannot recover. Furthermore, because the traditional rule requires adjusting your baseline withdrawal upward for inflation every single January, Robert's mandatory distribution quickly jumped to $44,000. Within just 36 months of continuous withdrawals during a flat market, Robert's core principal had already shrunk by 23%, triggering severe financial anxiety. Many traditional financial advisors still push static percentage models because rigid rules are exceptionally easy to market to anxious retirees seeking simple one-size-fits-all answers. However, elite institutional managers and sophisticated retirees abandoned fixed percentages years ago in favor of variable guardrail strategies adapted to real-time market fluctuations. The most resilient modern approach utilizes dynamic spending guardrails, which automatically adjust annual distributions based on portfolio performance rather than blind calendar dates. Instead of blindly pulling $40,000 forever, you establish a ceiling and a floor, allowing your lifestyle spending to flex slightly with market tides. When your overall portfolio valuation drops by 15%, the guardrail mechanism automatically trims discretionary annual withdrawals by just 10% to preserve underlying capital. Conversely, when strong bull markets push your investments 15% above initial projections, the upper guardrail unlocks bonus income for travel and family gifts. Had Robert implemented dynamic guardrails instead of rigid withdrawals, his portfolio survival probability across a 30-year retirement would have surged above 98%. While variable spending solves the structural math problem, psychological peace of mind requires insulating your daily living expenses entirely from short-term stock market volatility. Savvy retirees construct a dedicated cash buffer holding exactly 24 months of baseline living expenses inside high-yield money market funds and short-term treasury bills. This liquid shield guarantees that whenever Wall Street enters a brutal bear market, you never sell a single equity share to cover monthly utility bills. The second structural bucket holds 5 years of intermediate needs using high-quality dividend-paying blue-chip equities and corporate bonds yielding between 4 and 5%. Finally, the third bucket protects your long-term purchasing power against multi-decade inflation by keeping the remaining funds heavily invested in broad low-cost index funds. During prosperous market years, when equities surge, you harvest profits from your third growth bucket to replenish your short-term cash buffer back to 2 full years. When equities enter a correction or bear market, you simply pause all portfolio rebalancing and draw solely from your protected short-term and intermediate income shields. Beyond portfolio allocation, lasting wealth survival requires factoring in medical cost inflation, which historically outpaces broad consumer price indices by nearly double each year. To neutralize this threat, forward-thinking American wealth builders aggressively front-load health savings accounts during peak earning years to secure tax-free compounding specifically for later decades. Strategic retirees also optimize guaranteed baseline income by delaying Social Security claims until age 70, securing an immediate 8% annual return backed by the government. Combining delayed Social Security with dynamic portfolio guardrails creates an unbreakable financial fortress, but executing this strategy efficiently requires mastering one crucial tax minimization technique first. Instead of blindly pulling $40,000 every January, smart retirees in 2026 use dynamic guardrails built on Guyton-Klinger decision rules. When your portfolio surge pushes your withdrawal rate, 20% below its initial target. The prosperity rule triggers a 10% pay raise. Conversely, if a market drop forces your withdrawal rate 20% above the initial baseline, you immediately cut your spending by 10%. Think of dynamic guardrails like highway rumble strips that gently nudge your car back into the lane before you hit the ditch. Consider David, who retired with $1 million generating $40,000 annually right before the S&P 500 dropped 25%. Under Bengen's rigid model, David would blindly withdraw $41,000 from his battered $750,000 balance, devouring principal. With guardrails, David trims his annual distribution to $36,000, preserving crucial shares that will exponentially compound during the inevitable recovery. That temporary $4,000 sacrifice eliminates sequence of returns risk completely, boosting 30-year portfolio survival rates from 80% to 99%. But what if you cannot afford a 10% spending cut during a deep recession without skipping property tax or grocery bills? That exact fear is why modern wealth builders deploy a 2-year liquidity mode using short-term US Treasury bills and high-yield cash equivalents. By keeping $80,000 parked safely outside volatile equities, you sever the direct link between Wall Street panics and your monthly mortgage payments. Imagine your cash buffer as a backyard water tower supplying clean water during a drought so you never drain your main reservoir prematurely. When stock prices hit new all-time highs, you harvest equity gains to refill this liquidity moat back to its full 2-year capacity. When bear markets strike and equities plunge 20%, you freeze all stock sales immediately and live exclusively off your treasury bill interest and principal. Because post-war US bear markets historically last 20 months, on average, your 24-month cash moat comfortably bridges the gap until stocks fully recover. However, sitting on too much cash breeds a silent killer, compounding inflation that erodes purchasing power over 40-year retirement horizons. To defeat inflation without risking early portfolio collapse, seasoned planners implement what research calls a rising equity glide path during retirement. Traditional financial advisors tell you to buy more bonds as you age, but sophisticated retirees actually increase their stock exposure over time. You enter retirement conservatively with 60% equities and 40% defensive bonds to shield against sequence risk during those vulnerable first 5 years. Then, as you spend down those fixed income assets each year, your stock allocation steadily climbs toward 80%, fueling decades of inflation-beating compounding. This mechanism succeeds because sequence of returns risk peaks on the exact day you retire and steadily evaporates by year 15. Another breakthrough strategy gaining massive traction among savvy US retirees in 2026 is the variable percentage withdrawal method developed by quantitative researchers. Instead of guessing future market yields, this formula multiplies your current portfolio balance by a dynamically adjusted percentage tied directly to your remaining life expectancy. At age 65, you might withdraw 5.1% of current assets, while at 80 that withdrawal percentage rises to 8.4%. Because you only ever spend a percentage of what remains, mathematically running out of money becomes completely impossible regardless of market crashes. Think of this like adjusting a valve on a rainwater barrel. When the barrel is full, water flows freely. When half empty, the tap tightens automatically. Yet variable spending has one glaring vulnerability. Your fixed monthly grocery and utility bills do not shrink simply because the stock market dipped. To solve this vulnerability, seasoned financial planners separate retirement spending into 2 strict categories: the non-negotiable floor and the discretionary lifestyle budget. By delaying Social Security until age 70, to secure a 76% larger check, you permanently lock in guaranteed baseline survival income. Once guaranteed checks cover your basic living expenses, your remaining stock portfolio can safely ride dynamic guardrails without you ever fearing financial ruin. To understand why static withdrawals collapse, look at what happens when a market downturn strikes during your first 5 years of retirement. Sequence of returns is brutal. Imagine 2 retirees, each starting with $1 million and pulling $40,000 annually. One retires into a roaring bull market while the other faces a 20% market drop. When your portfolio drops to $800,000 during year 1, taking out that fixed $40,000 requires selling 25% more shares at rock bottom prices. Once you sell those discounted shares to cover living expenses, they are gone forever. Even when the broader market recovers, your portfolio has lost its engine. Meanwhile, the retiree who experienced early market gains sees compounding work in reverse. effortlessly generating enough yield to cover that annual $40,000 distribution without selling capital. Back in 1994, retirees could rely on intermediate government bonds yielding over 6% to buffer equity declines. Today, that fixed income safety cushion behaves very differently. Today's elevated Shiller-Cape ratios mean future equity returns over the next decade will likely fall below historical averages, compressing your margin of safety. So how do savvy retirees protect their capital in 2026 without sacrificing lifestyle? They abandon static percentages entirely and adopt dynamic withdrawal rules that flex with the market. The most robust modern alternative is the Guyton-Klinger guardrails framework. Instead of blindly withdrawing 4% plus inflation every year, you set strict upper and lower boundaries. If a market plunge pushes your current withdrawal rate above 5% of remaining assets, the capital preservation rule triggers an immediate 10% spending cut. That modest reduction turns a $40,000 distribution into $36,000 during lean years. This small sacrifice prevents portfolio depletion and lets underlying assets recover when markets rebound. Conversely, when bull markets push your withdrawal rate below 3% of total assets, the prosperity rule lets you boost spending by 10% to enjoy life. Guardrails transform retirement from a rigid countdown into a responsive ecosystem. You share a small portion of market volatility in exchange for absolute long-term financial survival. Another powerful strategy gaining traction among modern wealth managers is the three-bucket cash buffer. This structure isolates short-term living expenses from long-term equity volatility. Bucket 1 holds exactly 2 years of net living expenses in high-yield savings accounts or short-term treasury bills. This money is completely immune to stock market crashes. Bucket 2 covers years 3 through 7 using intermediate-term bonds, certificates of deposit, and high-quality dividend aristocrats. It provides reliable income while capturing moderate yield. Bucket 3 houses your long-term growth engine, consisting of broad market index funds and global equities. Because you never sell these shares during downturns, compounding runs uninterrupted. During bull markets, you systematically harvest profits from Bucket 3 to refill Bucket 1. When stocks tumble, you simply live off your cash buffer until equities recover. Beyond market volatility, retirees in 2026 face a silent wealth erosion that the original study ignored entirely. Healthcare inflation routinely outpacing general consumer price increases. Studies show that a 65-year-old couple retiring today needs approximately $315,000 just to cover out-of-pocket healthcare costs throughout their golden years. If your annual spending adjustment relies solely on standard CPI, your purchasing power will steadily erode whenever medical bills or long-term care needs suddenly spike. To counter this, smart wealth builders treat health savings accounts as a specialized retirement bucket, letting triple tax advantage funds compound untouched for decades before claiming reimbursement. There is also the challenge of longevity. When Bengen tested the 4% rule, he assumed a standard 30-year timeline ending at age 95. Today, a healthy 60-year-old couple has a 50% chance that at least one spouse will live past age 92, requiring a 40-year financial runway. Extending your payout period from 30 to 40 years drops the historically safe fixed withdrawal rate from 4% down to roughly 3.3%. However, locking yourself into a rigid 3.3% rate forces massive lifestyle sacrifices early in retirement when you are healthiest and most active. To solve this longevity puzzle without living like a pauper, retirees turn to variable percentage withdrawals, which calculate distributions using updated actuarial life expectancy every single year. By combining your current portfolio balance with your updated life expectancy factor, your annual withdrawal adjusts naturally, guaranteeing your money lasts exactly as long as you do. Notice how all these modern strategies share one core philosophy: flexibility. Instead of crossing your fingers and praying the stock market cooperates, you stay in complete control. Yet even the smartest dynamic withdrawal rule can lose thousands of dollars if you pull money from your accounts in the wrong tax sequence. Let's look at how the capital preservation guardrail actually operates when your retirement portfolio faces a sharp market drawdown. If your initial withdrawal rate jumps 20% above its target due to a drop in portfolio value, the mechanism immediately triggers a 10% pay cut. That slight temporary reduction preserves your core capital precisely when selling depressed shares would cause permanent irreversible damage to your nest egg. Conversely, when strong bull markets push your current withdrawal rate 20% below the initial target, the prosperity rule triggers an automatic 10% spending raise. Instead of blindly taking $50,000 adjusted for inflation every single year, you flex your paycheck dynamically based on real portfolio health. Historical modeling shows this dynamic flexibility allows retirees to safely start with an initial 5% withdrawal rate without exhausting their money early. To execute this smoothly without panic, smart money separates savings into 3 distinct liquidity buckets tailored for specific time horizons. Bucket 1 holds 2 full years of living expenses entirely in cash equivalents like high-yield money market funds and short-term treasury bills. If you need $60,000 annually from portfolio withdrawals, Bucket 1 maintains $120,000 completely shielded from stock market volatility. When stocks drop violently, you live directly off this cash reserve, allowing your long-term equity investments time to recover without forced liquidations. Bucket 2 acts as the bridge, holding 3 to 5 years of income inside intermediate government bonds, high-grade corporate debt, and conservative dividend-paying funds. This intermediate bucket generates steady interest yields while replenishing Bucket 1 whenever your short-term cash reserves begin to run low. Finally, Bucket 3 contains the remaining balance dedicated entirely to diversified global equities designed to outpace long-term inflation over decades. Only during profitable market years do you harvest gains from Bucket 3 to refuel your conservative cash and bond reservoirs. This disciplined bucket structure transforms emotional panic during bear markets into a calm mechanical refueling routine that protects lasting wealth. Another proven strategy gaining massive traction in 2026 is building a dedicated bond ladder using Treasury inflation-protected securities to cover core expenses. By matching exact bond maturity dates to future annual budgets, you lock in guaranteed government-backed purchasing power regardless of inflation shocks. If your basic survival needs cost $40,000 a year beyond Social Security, your bond ladder guarantees that precise cash flow automatically. Once those essential survival costs are completely guaranteed by fixed income, your remaining stock portfolio can safely absorb severe volatility without threatening your lifestyle. For retirees who still worry about early market crashes, financial planners now use an innovative asset allocation path called the Rising Equity Glide Path. Instead of shifting more heavily into bonds as you get older, you actually start retirement with a conservative 50% stock allocation. Over your first decade of retirement, you systematically sell mature bonds and slowly increase your stock exposure towards 70% of total assets. This counterintuitive upward slope deliberately reduces your equity exposure right when sequence of returns risk reaches its absolute most dangerous peak. As you survive that vulnerable first decade without major drawdowns, increasing your stock allocation protects your portfolio against long-term purchasing power erosion later in life. Let's examine how these dynamic approaches compare directly against the rigid 4% rule using a real $1 million retirement nest egg. Under the old rigid model, during a prolonged market downturn, withdrawing $40,000 plus inflation year after year rapidly accelerates total portfolio depletion. In contrast, a dynamic spender who cuts withdrawals by just $5,000 during bear market years extends their total portfolio survival by over a decade. That modest temporary adjustment requires minor lifestyle flexibility today, but it completely eliminates the terrifying risk of running out of money in your 80s. Another crucial shift in modern retirement planning involves optimizing asset location across taxable brokerage accounts, traditional IRAs, and Roth accounts. By withdrawing strategically from different tax buckets based on annual income thresholds, smart retirees keep thousands of extra dollars growing compounding interest every year. Instead of rigidly withdrawing 4% every year, modern retirees use dynamic spending guardrails to automatically adjust payouts during market turbulence. This Guyton-Klinger framework establishes strict ceiling and floor percentages, preventing destructive capital drain during severe economic downturns and prolonged bear markets. When your overall portfolio value drops by more than 20%, your annual distribution automatically shrinks by 10% to preserve critical core assets. That modest temporary cut eliminates the need to liquidate depressed index funds at rock-bottom prices, shielding your baseline compounding engine from permanent damage. Conversely, when markets surge and push your portfolio 20% above its initial baseline, you grant yourself a 10% raise to enjoy those gains. Beyond spending rules, the second massive shift in 2026 involves replacing blind bond allocation with a precision 3-bucket cash flow architecture. Your first bucket holds exactly 2 years of baseline living expenses safely parked in short-term treasury bills and high-yield savings yielding 4 to 5%. This dedicated liquidity buffer ensures you never sell a single share of stock to pay for groceries during an unexpected stock market crash. Bucket 2 acts as your replenishment engine, holding 5 years of intermediate treasury, inflation-protected securities, and conservative dividend growth funds to combat steady inflation. Finally, Bucket 3 contains your core equities in low-cost total market index funds, left entirely alone to compound over a 15-year horizon without interruption. Notice how this specific 3-tier structure completely insulates your long-term growth assets from short-term volatility, eliminating the emotional panic that ruins most retirements. But the most powerful mathematical lever in modern retirement planning is using a cash bridge to intentionally delay claiming Social Security until age 70. Every single year you wait between 62 and 70 locks in a guaranteed 8% inflation-adjusted increase to your permanent monthly government payout. By spending down your short-term bonds from age 65 to 70, you effectively buy an annuity backed by the federal government at unbeatable rates for a couple needing $80,000 annually. Boosting guaranteed income from $30,000 to $50,000 drastically reduces portfolio withdrawal pressure. Once that higher inflation-protected floor kicks in at 70, your portfolio only needs to generate $30,000 a year instead of $50,000. That simple bridge strategy drops your required portfolio withdrawal rate from a risky 4.5% down to a rock-solid 3% flat. At the 3% withdrawal rate, historical Monte Carlo simulations across every 30-year period since 1926 show a 100% portfolio survival probability. Another dangerous trap modern retirees actively avoid in 2026 is chasing ultra-high yield covered call ETFs or junk bonds simply to generate cash flow. While a 10% dividend yield looks tempting on paper, those complex derivatives cap upside appreciation while exposing your principal to severe downward erosion. Focus exclusively on total return rather than yield, because selling a tiny fraction of appreciating index funds is mathematically superior to collecting taxable dividends. Selling shares on demand lets you control your exact capital gains tax bracket, whereas forced dividend payouts trigger unnecessary taxes even when markets stumble. To execute this flawlessly without running out of money, wealth coaches advise maintaining a variable percentage withdrawal schedule tied to your current age. Under this variable schedule, your withdrawal percentage gradually climbs as your life expectancy shortens, ensuring you extract maximal lifestyle value without premature depletion. At age 65, you might safely withdraw 4.2%, whereas by age 80, the math supports taking 6.5% annually. Combining this variable payout curve with guaranteed Social Security creates a resilient spending floor that adapts smoothly to changing economic realities and longevity risks. You gain the peace of mind to spend confidently during prosperous bull markets while automatically protecting your capital whenever macroeconomic headwinds begin to blow. That flexibility transforms retirement from a fearful guessing game into a calm engineered cash flow system designed specifically to survive the decades ahead. But there is one final critical piece of the retirement puzzle that can either save or destroy hundreds of thousands of dollars in taxes. How you order withdrawals across traditional pre-tax IRAs, Roth accounts, and taxable brokerage funds dictates exactly how much of your wealth the IRS takes. Instead of blindly guessing inflation every January, dynamic spending guardrails adjust your withdrawals using real portfolio thresholds. You trim spending slightly only when severe bear markets hit. When surging bull markets push your balance above the upper threshold, this mechanism triggers a permanent 10% spending raise. Your lifestyle upgrades automatically without jeopardizing your principal. Smart retirees pair these guardrails with a dedicated 2-year cash buffer inside treasury bills. You never have to sell depressed equities to cover your monthly living expenses. Another powerful tool is building a tips ladder that locks in guaranteed real yields above 2%. This creates an indestructible income floor backed by the federal government. By combining that bond ladder with Social Security, your baseline overhead for housing and food is completely covered. Stock market crashes no longer threaten your core basic needs. That frees your remaining capital to stay invested in low-cost index funds for decades. Those equities fund your discretionary travel, family gifts, and generational wealth without stress. Furthermore, modern withdrawal sequencing prioritizes taxable accounts first to maximize the 0% long-term capital gains bracket. This simple tax strategy saves you over $5,000 every year. You also execute strategic Roth conversions during market dips before reaching age 73. This proactive move permanently diffuses the tax bomb of future required minimum distributions. Healthcare demands its own mechanism too, utilizing triple tax-advantaged health savings accounts. Paying Medicare premiums directly from your HSA preserves thousands of dollars in taxable retirement income. Finally, tying variable withdrawals to current cap valuations prevents overspending during speculative bubbles. When market valuations reach historical extremes, you temporarily tighten your belt by 5%. This dynamic multiple bucket framework gives you true financial serenity in retirement. Your daily peace of mind is never again hostage to Wall Street panic or random volatility. The 4% rule is obsolete, but dynamic guardrails and real income floors guarantee your wealth outlives you. Like this video if these concrete mechanisms gave you clarity today. Comment which withdrawal rule you trust most for retirement and subscribe for slow wealth building. Next week we expose why dividend investing might secretly destroy your total returns.